Investing for your child is one of the best ways to build wealth for them at a young age. In this video, I'm going to break down 4 accounts you can use to invest for your child. What's going on, everyone? My name is Maoli Vodi with Financially Present, your one-stop shop for financial and investment education, and we're talking about custodial accounts and other accounts that you can have for your child so that you give them a leg up in this world and invest for them, because the earlier you do this, the more opportunities their money has to build on itself through compounding. I have 2 kids of my own, and when they were only a few weeks old, as soon as we got that Social Security number, we opened up custodial accounts for them, among other accounts. And these were the building blocks in order for their wealth to start working for them, so that when they get to a certain age, they will be further ahead as far as the race is concerned. In this video, we're going to talk about 4 accounts, starting off with the custodial account, a Coverdell account, a 529 account, and then also a custodial Roth IRA. Let's get into it. When a child is born, I think the least important account to open up for them is a bank account. I don't want my kids having a bank account until they're about teenagers. Because think of it from this perspective, it's still a low interest rate environment when it comes to account interest from banks and checkings and savings accounts. And ultimately, at their young age, they're not going to be making deposits and withdrawals. Mainly, it's going to be deposits. So what better account to start with than a custodial account? The big takeaway for a custodial account is that it is the most flexible account for a minor. A custodial account is the same as an individual account would be for an adult. And in some states, or in most states, they're either going to be called a UGMA or UTMA account. That's Uniform Gift to Minors Act or Uniform Transfer to Minors Act. And depending on whichever state, the age of majority would be 18 in most states, or 19 or even 21 in some other states. But ultimately, once they hit that age of majority, it's completely theirs. Any money that's been put in is completely theirs. There's no obligation for the money to be spent towards college or anything constructive. They can decide they want to use the money for tattoos or use it to buy multiple cars if there's that much in there. But ultimately, there is a lot of flexibility. And depending on where you have the account, you can buy whatever type of investment. So if it's held at a regular brokerage firm like a TD Ameritrade, Schwab, Fidelity, they can own stocks, mutual funds, exchange traded funds, CDs, bonds. There are a lot of options to invest in when it comes to a custodial account. The flexibility that I like about this type of account is that you can just put stock in there from your own accounts. So you can gift stock from your individual or joint account directly to your child's account, and it is considered an irrevocable gift. So it can never be taken out of that designation. It is going to be for your child. So, and that also goes for cash that's deposited into the account. And anyone, not even just you as parents, but anyone, so that's all relatives, can decide to write a check directly to the child. You as the custodian could sign the back of that check and say, as custodian for your child, and deposit it directly into their custodial account. Because this account is designed for a minor, there's some level of prudency that needs to be considered. So you're not going to be able to do anything like trading on margin or day trading consistently in this account for your child. And you also aren't going to be able to do speculative options trading strategies in the account. But ultimately, it's all for the benefit of the child to protect the money that's in there for them. One of the reasons why this account is so flexible is that if you're blessed enough to put as much as you want into this account, you actually can. You can put as much as you want into a custodial account. But keep in mind, any amount over $16,000 is going to be considered for the gift tax. So that's something to be mindful of. But that applies on an annual basis. And when you consider what's been put into a custodial account, when it comes time to go to college, this is all going to be factored into the expected family contribution. So keep that in mind when you maintain a custodial account. And that leads us to some of our other accounts. The next account is a Coverdell Education Savings Account, or Coverdell ESA account. And the big takeaway here is that the contribution limit for Coverdell accounts is much lower, but It's all designed for education, and there are some income limits, even though you have a wide variety of investment selections. With the Coverdale, you can only put up to $2,000 annually into this account, and that amount can be invested in stocks, mutual funds, ETFs, bonds, all types of investment instruments that are available at your current broker. And when you pull out that money, the gains or the growth of that money can be used towards qualified educational expenses in order for it to be tax-free. So when we talk about qualified educational purchases, we're talking about tuition, books, room and board, and other materials used for school. Although the contribution limit is just $2,000, anyone can contribute to a Coverdell account for a specific beneficiary. So if I open up a Coverdell account for my son, that doesn't stop his grandmother or his aunt from opening a Coverdell account as well. They just have to meet the income limitations or requirements, and they could contribute their own $2,000 or their own $2,000 here and our own $2,000 for the same individual. As long as it's going to be used towards educational expenses and they meet the salary or the income limits, then it's perfectly fine. And this brings us to our next account for kids, 529 plan. The key takeaway with the 529 plan is that it allows you to put the most away for education. It's the easiest when it comes to set it and forget it, but the investment selection is a little limited. There are other aspects of flexibility though when it comes to a 529 plan, okay? Because this is an education-based account. It is a state-sponsored plan. So there are some variances when it comes to your state. So always double check with your state's 529 website. But ultimately, you are the owner of the account and you can select the beneficiary and then change the beneficiary. So I could decide I want to save for my daughter with a 529 plan. And then if she decides she does not want to spend the money on college because this is an education-based account, I could actually change the beneficiary to her younger brother. If he decides to go to school, we can use that money for qualified educational expenses. And if he doesn't want to go to school, I can actually use it for myself. Let's say I want to go back to school and get my master's or get a PhD, I can use it for myself. But ultimately, there are a host of people that can actually benefit from this money. As it grows, it's going to be tax-free, assuming you spend it on qualified educational expenses. There are two types of 529 plans, and they're not offered in every single state. So again, you do have to check, but there's the prepaid option, then there's the savings plan option. With the prepaid plan or prepaid option, you are literally paying for college ahead of time. So you pay in today's dollars at today's prices, but it would be for future benefit of enrollment. Okay, so if I wanted my child to go there in year 2037, I could be paying 2022 prices for tuition. And it has to be according to that specific state that qualifies for that type of plan. The more common version of the 529 plan would be the savings plan perspective. And that one well, essentially you'll just be investing in a mutual fund, and there are various options that are available to you, but it's set it and forget it. Each month you would contribute a specific amount and it will continue to grow and compound. And there are different selections where they get more risky, or they're risky now, and they get more conservative as you approach the point of where you need to use the money for college. So there are some flexibility options when it comes to 529 plans. With 529 plans, there's no annual contribution limit. Okay, so you can put as much as you want in the account. But again, we do know that there is something called the gift tax. Okay, so any amount given over $16,000 is going to be subject to the gift tax. But 529 plans, they do have a provision that allows front loading. So it'll allow you to put up to 5 years worth of the gift tax allowance. So 16,000 times 5. So if you just opened up a 529 plan for your child and you had a lump sum of money you wanted to put in, you can actually put in $80,000 in upfront so that they can start working towards the investment goal for your child's college tuition. Just know that you can't put into it again for another 5 years, all right? But it allows you to do that ahead of time. 529 plans also allow you to receive deposits from, let's say, relatives who want to provide a gift for your child. they could directly deposit into that account. I've seen it where you can even provide a code and that relative can deposit online and it goes directly to your child's 529 plan. So there is some level of flexibility. If you aren't familiar with how to open up a 529 plan, feel free to check out my other video where I go step by step and do a screen share and show you exactly how to open one up. It's pretty simple. And that leads us to our last account, and that's going to be our Custodial Roth IRA. The big takeaway here with the Custodial Roth IRA is that the principal can be taken out at any time tax-free, and any of the gains once your child hits retirement age, which is far from now, can be taken out tax-free as well. So the benefit here is that you are giving them a head start on retirement, a tax-free head start on retirement. This is all assuming you follow the right rules, and they're not too hard. A custodial Roth IRA is the same as a regular Roth IRA. Essentially, it's just for a kid. You have to be able to prove that your child is employed and working though. Okay, so this is more geared towards business owners because they're able to have a little bit more flexibility in the positions that they can offer and employ their own kids. The maximum contribution limit for your child is going to be $6,000, but you have to make sure that their income that you're reporting lines up with that. If you have a child that you've paid $3,000 to, you cannot meet the $6,000 contribution limit. You can only put $3,000 in, okay? If for some reason they make $12,000 for the year, you still can only put a maximum of $6,000 into their Custodial Roth IRA. The real benefit here with the Custodial Roth IRA is that it is going to grow tax-free essentially until they retire. As long as the money continues to be invested, it has the earliest opportunity to grow on a compounded level tax-free, especially because they can always decide to take out the principal tax-free, but assuming it is left untouched, the principal, the investment, and any future contributions are going to continue to grow and compound for the benefit of your child. So when they eventually hit 59 and a half, then they don't pay taxes on anything they pull out of that account. It may seem a little tricky though when it comes to how you want to employ them. I've seen different ways. If you're a hairdresser and your child helps clean up, they can be paid. If you are a content producer and your child knows how to operate a camera, or they are a model for your business or a model for a brand, then ultimately they are working and they could be paid for it. And these are some of the different ways that you can do this so that they will be able to contribute to a Roth IRA, or you would be able to contribute for them. Please, please, please consult with a CPA before you do any of this and make sure that you are able to, if presented with an audit, contest this and defend this. So what account are you going to open up for your child? We have a custodial account, we have a Coverdell, we have a custodial Roth, and then we have a 529 plan. I know my kids have a custodial accounts each, and then they also have 529 plans. What are you going to open up for your child? If you like this video, subscribe if you're new to the page and turn on notifications so that you don't miss out on future content. And until next time, stay present.